I'm Jay Taylor. I'm the editor of a newsletter called Jay Taylor's Gold, Energy&Tech Stocks. I'm also the host of a radio show called Turning Hard Times into Good Times. I'm here at the Metals Investor Forum, September 6, 2019, and I'm really pleased to be with Doug Ramshaw. He's the president of Minera Alamos.
Thanks, it's good to be here, Jay.
Really good to meet up with you. I've heard some things about your company. You're a very experienced operational team. And you have a project that's nearing production, or it's getting close to it, in Mexico, an open pit oxide heap leach operation. Talk to us about that. How close are you to it? What are the economics looking like? I think you've done a PEA on it at this stage. So talk to us about that, and then you have a second project I'd like to hear about as well.
Sure, yeah. No, we are an operating team that's been working in Mexico for the last 12 years. Team that was behind the Castle Gold success in 2008-10. So we're no stranger to building operations. It's the passion of our technical team is actually to build things. So the first operation that we're looking to put into production is called Santana. We recently received our final federal permits for that, so we are permitted. We expect to start construction of what is a very modest 10 million Canadian capital cost. That will start in November. And in the next 4 to 6 weeks, we'll be presenting a funding package to the market, non-equity based, to actually build that very modest price. So it will start at 30,000 ounces a year, and we'll scale it up from there. But we're going to start small and just scale it out of cash flow, which we think is very beneficial to shareholders, rather than the constant dance with the equity markets.
Oh, for sure. Yeah. How many shares out there now, and what's your market cap?
Well, right now it's funny, and I always feel like I'm picking on the people of Manitoba because they say, we have 376 million shares out, almost no warrants, so it's just straight shares in the company. If we were exploring moose pasture in Manitoba, that would probably be a problematic share structure. But as a fledgling gold producer, you're much more of a market cap story. So we're about 65 million Canadian, 50 million US capex market cap right now. And it's been a good run over the last little while with the gold price. But I actually think that the move in the stock has not been a factor of the gold price. It's actually been a factor of us executing on the things we said we were going to do. And I think execution is really the cornerstone of our business model.
It certainly is a key, isn't it? And you have the track record to go with it. So on your PEA, how does let's say the present value, the NPV, compare with your current market cap?
Well, the second project that we would be bringing on stream is the one with the PE, and that's La Futuna. It's still a modest capex build. It's only about 26 million US for the 50,000 ounce a year operation. All-in sustaining costs of about 440 US an ounce. So we model everything at $1,250. We stress test it at $1,000. We do not need $1,500 gold, but I've always said the best way to take advantage of a gold market is to be producing the stuff. And we're one of probably a handful of companies that right now are not in production, but this time next year we'll be a new gold producer, and that obviously the gold market is going to help a lot with that. So the two combined, probably we can see about 100,000 ounce a year production profile inside of about 2 years at a blended all-in sustaining cost that's sub $800 an ounce, $750 maybe. So very well poised to take advantage of the gold market we're in.
Yeah, if we're at $1,500 gold now, it's a nice margin, and
absolutely.
We hope to see that maintained and something better even possibly, but you can't think that way as a miner. As a miner, you always have to be conservative. So on the first project, the one that's closest to production, you've not done a PEA on that, and you're doing 30,000 ounces a year. What is the upside there? Or is it rather limited? Is it something you just see as a means of building some cash flow to finance other projects, or what?
That's a fascinating question, because in many ways, we initially looked at it as a project that would be the low capex kind of, let's build a small asset that will give us that foundational cash flow so that we can take some debt on to build the second one. But our understanding of the project over the last year now, we see Santana in its own right as something that can be a meaningful 60, 70,000 ounce a year producer in due course. Any asset that we look at, we don't necessarily define all the ounces out the gate. We'd rather define enough so that the rest of the ounces can be funded out of cash flow. Their discovery can be funded out of cash flow. So we look for projects that can have that million and a half ounce potential, and we'll test that potential out of cash flow. So now, yeah, we actually think that Santana in its own right is going to be a very significant gold producer, and that's just really taking an asset that was perhaps not properly geologically understood in the past, and applying some more modern insight into what we're really looking at there, and so it's going to be very meaningful, we think.
And these projects are located where?
Santana is in Sonora, and Futuna is in Durango, so northern Mexico, which is where we'd like to operate. Yeah. There are companies operating in southern Mexico, and I take my hat off to them because it's a tougher part of the country. Yeah. We're in Sonora. The governor there is very pro-mining, supportive. It's not a surprise to me to see the likes of a Silvercrest getting permitting done recently, and likewise ourselves. It's a very mining-friendly part of Mexico.
Yeah, it certainly is. Silvercrest is a story I followed, and they're
amazing story.
Amazing story.
Yeah.
And silver, well, anyway, gold is gold, and we really love gold, that's for sure. So, yeah. And then your Futuna project, that really sounds very attractive to me. The grades are pretty high. That's a milling operation, I believe you said, and it's. Talk to us a little bit about that.
Yeah, it rates. We just did a PEA off an initial 5-year high-grade starter pit. It's about 3.5 to 4 gram open pit, about a 6-to-1 strip ratio, and that's why the all-in sustaining costs are so low. It is a project that we will use some debt to build, and I know talking to bankers that want to help us with the debt.
They sure do.
Their last comment to us was, we just can't break this project. When they model it and try to stress test it, it's incredibly robust. And whilst it is only going to start off that 5-year, 50,000 ounce a year life, there's lots of exploration upside for us to expand through brownfields and greenfields on the project itself.
Yeah. So they want to do a gold loan with you or something like that?
Oh, it would be very vanilla debt. I think that's a route. I personally, our funding will be through very vanilla, straight debt, or in the case of our biggest shareholder, potentially royalty money.
Sure.
I think gold loans and gold streams can be problematic if you have startup problems, right?
Yes,
so no, we're not looking to go down that path.
So speaking of your bigger shareholders, tell us about who owns your company.
Yeah, so Cisco Gold Royalties owns 13% of the company. We have 2 generalist funds, Donald Smith and Aegis in the US, that own about 15% between them. And then there's a bunch of institutions and management that own probably another 15% between them. My CEO, Darren Kernaghan, probably in the last 4 years has bought about $500,000 worth of stock out of the market and owns 6 or 7 million shares. I've bought about $400,000 worth of the stock in the last year in the market, because we really do align ourselves with our shareholders, and so we're proud shareholders, and we're going to make sure that our shareholders, as we are hopefully well taken care of with our execution of the business plan.
Well, there are not that many junior mining companies that have the ability to put something into production. And I guess you also do some exploration once you're in production as well, but I suppose.
Oh no, for sure. The business model dictates that we're going to expand the projects through exploration. So we get the best of both worlds. We get the excitement of the exploration and discovery part, but with a foundation of production and cash flow that I think is exciting.
Yeah, because a lot of times it's that stage when you've made the discovery, now you're going to go into production. It's the engineering, it's the financing, it's all this stuff. Markets sort of go ho-hum, but right now we're in a bull market for gold, and if you're undervalued, I think anybody that's got any sense, they're going to take a look at you and see what it looks like relative to your share price. So it's certainly something I want to do when I get back to New York.
Sure.
I have to do it now, I think.
Happy to go through some more questions with you, Jay, when you're back there.
Owe it to myself and my subscribers. And so in looking forward, what's the drivers? What should we be keeping an eye out for?
We're actually in the middle of a 10,000 meter drill program, so there will be results coming out October through the rest of the year from a drilling perspective. The big news will be, seeing construction starting sometime in November, and between now and then we'll have the funding package announced that will allow us to do that funding. We have the permits now to build this, so I'd like to address that issue to the market, that it is low capex to build, but show us the money to have it, and we have a good balance sheet right now.
Good.
So there's a lot of news flow over the next 3 months.
Wonderful. We'll keep an eye on it. Thank
Okay.
you so much.
Thanks, Jay.